Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for about the next 20 minutes here on Options Guide TV. It's going to be short and sweet. I'm going to just look at a zero DTE trade, and I'll tell you that it's kind of been fun with the gold scenario. I kind of like just playing in this underlying. I found two new underlyings that I really like to deal with butterflies. Just in general, gold had some views going into the Fed meeting. This trade has worked out great, and so I want to talk about that trade, and then also UNH, United Health. It has another $300 stock, which if you have a little bit more expensive stocks that have a little bit of volatility and a little bit of predictability. UNH has had some struggles, brought up some volatility because of that. And then we have talked about the insider buying. I actually added in my retirement portfolio. I sold some puts. I don't think I'm going to get put on the stock, but I went out 14 days and got some premium, and I'm happy to buy it a little bit lower. If we get back to the lower end of the channel, where I sold that put at, I think I got $5 for the one put. I just want to buy an additional 100 shares. I'm happy to take it down at the bottom side of the channel. But right now, let's look at the gold trade, and then let's look to get an SPX trade on. I see. Hey, Kurt, we've already got a lot of comments. Yeah, on Wednesday we pegged the trade in the SPX. Pinned, if I use Kurt's word. Pegged is my word, but pinned works. We pinned at 660. Yeah, we did an SPX butterfly, and I can't show it to you mainly because the options had expired because it was a zero DTE trade. And we were looking for less volatility after the Fed meeting. And the real risk was that maybe the Fed goes 50 basis points instead of 25 basis points because of the new appointee that they have on the as a part of the Fed governors, all those type of things. So there was risk, and there was real risk that something out of the ordinary could happen, but it didn't. And guess what? The market didn't do anything, and it pinned right at 660. I personally did a 20-point wide butterfly, and I paid $2 for it, and I sold it for $4. So I got out fairly quick. But if you rode it all the way to the end, that would have been worth $2,000. Ideally. So happy to take the award. And if you stuck all the way to the end, guess what? You get a lot of money, and you also get the stupid award. And we've talked about that a lot, that if you do butterflies and you ride them all the way to the end, expecting the market to stop right where our middle strike is, I say that with jocularity, of course, because ideally you did really well, but if it pins right at that strike, you just got lucky. And but it still was a wonderful trade, and those trades have been doing well. There's, the downside, like doing one today and putting it on, is that the volatility has came off. And there's a lot of difference in just if you compare the VIX, looking at the VIX at 17 or 18 on a zero DTE SPX trade versus the VIX at 14 or 15. The cost is immensely different between those two. And now it really equates to the 1 day implied volatility. We're looking at the VIX just as a gauge because it's simple, but that really matters a ton. All right. But the one underlying that I'm really enjoying playing with at this point in time, because of the economics of the marketplace, is gold. We put a trade on gold heading into the Fed report, saying that we're going to do a September 19th trade on gold. Let me go take a peek on that. I think I got the wrong expiration up right now. Gold was, yes. That's why I was looking at the VIX trade. With gold, as far as the expiration is concerned, it is the 19th. I got that right? I put this trade on in a lot of different places. Yeah, I'm pretty sure we did the 19th. So let me change this up. I was looking at the VIX trade. Here's the 19th. And just looking for gold to settle down. It's really almost an exhaustion play that we look to put on, and that's mainly because gold had such a strong run up. As a matter of fact, gold is interesting. If you look at the RSI in gold, and I kind of noted that that actually is uh, a real good indicator. Gold, the price of gold and GLD, whenever you get to that overbought area, it always seems like it backs off a little bit. And the RSI got up above 70. And if you look at the chart and you look at the comparison over the last couple of years, it's a fairly solid indicator that you might get a little bit of a sell-off. And it's gold. I mean, your volatilities, like right now, the implied volatility going out to the 24th is $12. Going out to the 26th is is 12% vol, 14. Like, you don't have a ton of implied volatility, but you have really good markets and you have a high priced underlying. The more high priced the underlying, the more expensive the option contracts are going to be. So you have something that has some volatility and some predictability. Interesting enough. And so we played this to the downside. We went and put this trade on, and geez, I lost my screen grab. I think you guys got to help me out there. It was the 9/19 expiration, right? And that's right. And we paid $3 for it, and it's trading for $4.30 right now. But we might pin on this one. Is that right, Anthony? $2.60. Woo! Attaboy. So yeah, good week here on Options Guy TV. Strikes were 330. Yeah, I did it on many of them. Really? Yeah, that's right. I got it right, Anthony. I'm showing it on the screen. Thank you. Filled for 260. I appreciate that, guys. And now it's right now at 429. So there are many opportunities to come out and do the trade. Now, so if we're looking at where gold is at, if we pull up, let's send it to the what if calculator. Let's do that. And we'll look at it right now. So here's the situation on gold that makes you a little bit nervous. Like, you're on the wrong side of the tracks, if you will, in that at 338, we could come back and give up some of those gains, right? Now, if we're on this side of the butterfly and the market went up, well, we're still would be okay on this. This is based off of today's prices, but if you traded it for 260, you're still going to be okay on the trade. The difference between the strikes were 334, 42, 3. So 6 and 2, 4. Okay, we paid 260 and it was $4 is what it could trade for. So you're looking at $1.40 is the maximum that you could make if the market went this way. So in this instance, if we were on this side of the equation, I would be like, it's okay to see if we get pegged, right? It's okay to trade. And if it comes back and hits the middle strike, you just get out and you don't take this risk. But now you're on this side, on the wrong side of the tracks, on the wrong side of the P&L. So I would get out of the trade. I don't want it to snap back and bounce up to the 342 level. So if I'm on this side, I can play around. On this side, I just get out. There you go. That's the one lesson from today. Kurt said that he also filled at 260. Excellent. So yeah, and that's on the gold trade. So yeah, two really solid trades. Let's go look at UNH. Let's look at the chart on UNH. So we got this consolidation right in the middle here. So I'm going to go all the way back to this area where this gap is at, and we never did fill that gap, right? So the top of the channel is 377. We came back down. I think I sold some 330 puts is what I think I sold. And got $5 for them. Yeah, it was $5 for one put. And the market was up probably in this range, right around 340. And I said if it would come down to this range, I'd be happy to buy some more. Got this channel. I think we bounce. Let's do another one of these. I think we bounce right here. What do you guys think? What do you like that look? This is the high end of that candle. came back down. If anything, our next level of support on the downside is at 325. So we go 330, 340, 355. All right, that'll be the paper trade. I'll do that one instead of looking at, we'll go out 1 week. I like the way that chart looks. We got 1 week, 14th, 19th, September 26th. We're going to lean on the call side of things. $337.50. Did we do 5 and 10? Okay, let's go. Let's try this one. 330. On the bottom end of the chart, we're at 330s right there. Yeah, I think I see some support. Okay, so let's do that one. Or else we'd go down to the 325, but the 330 is right at the bottom of that candle. All right, 330, buy, sell 2, and if we go 5 points, we buy that one. Then we got to go 2.5 and buy this one. That's going to be expensive. Not too bad. 1 week, 332, and I think we get $5 on the upside, so about 170 if the market goes up. Send to the what if calculator. Yeah, so keep your eyes right over here, right over here. That's where your profit and loss is at. If the market goes up above this, it looks like it grabbed 338, so it'd say 162.50, somewhere in that range. Still like this chart, and I still like to lean bullish on it. Obviously, like I said, I've owned the stock. It's the one I had some fodder going into September and October. Still expect to see a downturn. I still just think the markets are too toppy, and we talked about the VIX trade. I'd rather just buy VIX calls outright, going with the September expiration, and I like that trade. And I'd rather just buy the calls outright and maybe sell a call later on. If things aren't working out and I get to October 10th, then maybe I sell some premium against it to try to save it, roll into a long call spread. But right now, this is going to be the official paper trade for today. We're going to look at doing, it'll be, so 750 will be the upside up to here. We're going to put it on for $3. It's called 320. Yeah, I like that. 320. I saw it. That means it filled at 320. I smile. That's the midpoint of it. If we could get this done for $320, that would be our max risk per 1x2x1 open wing butterfly that we did. And if the market goes all the way up and we do get that move where it fills the gap, we can make around, well, it would be 180. If we got done at 320, we would get 180 for it. On the downside, our risk is 320 below that 330 level. And if we just look at that little chart, I think the stock's going to have a tough time trending on the way down. The way that I look at the chart right now, just by taking a peek at it, is that this is a period of consolidation. It really needs to fill this gap, and I think it's going to want to fill that gap sooner than later. But it's right now in this period of consolidation. If we come back to here, I think it's going to start setting a new channel, kind of how it did in this range before it broke out. Has a tendency to do that in this underlying stock. So doom, and then it breaks through here, and the next stop is here. So this is a point where I would definitely want to buy it. I could even see getting long calls on a short-term basis and see if you can ride the wave from 360 up to the top of this gap down, which is 377 in that range. That's what my outlook would be on it. But I like this trade, selling some of this premium. We're still getting vol. Yeah, here we're 30% vol. 30%, I guess, is more normal, more muted on the implied volatility. The last one that we did, we were at 40% implied volatility. Oh, here's the earnings over here. That's around 40%. So a little bit less vol, and so that means we got to pay up a little bit more for that. UNH was 345, 350 when we did the trade. Kurt, so Kurt, go ahead and put the comment on Kurt. But that trade, I considered that we would go ahead and pop that one up. Yeah, there we go. UNH 335, 345, 350. And that was on the call side of things. There you go. And he put the call in. Yeah, and that trade worked out too, right? Kurt, didn't you get filled on that? All right. So I want to also mention that I am doing a podcast now, and with the Options Insider. So we're doing a podcast. I'm doing more and more stuff all the way across the board, working with Tradier. We're going to do more and more with Tradier. We got a big event that's coming up with all the speakers that is out there. I'm excited about it. I'm excited to just do more. I love the fact that Tradier is sponsoring this hub. They're putting all these great speakers together. We also, get in the chat room, even talk about fantasy football every once in a while. So we do got a league of option traders that are trading fantasy football, which is just kind of funny to me that it all worked out. So I think that's fun. Here's the gold trade. And I don't mind even looking at a gold trade. How about we look at a gold trade today too? We're at 1120. So this is the official paper trade. We're going to go out 1 week. We're going to do UNH. We're going to look for that move to the upside. On gold, now I might even lean to get a little bit more bullish on gold. So going all the way back, we did a trade on gold because I was looking at the screen grabs that I had. We did a trade on gold a while back that was bullish, leaning in. We did a UNH. We did a Starbucks trade and we did a gold trade. Starbucks is just hanging out. The Starbucks trade is still on, by the way. It's 45 days out. There were opportunities to close it out, but the stock is just meandering along. If we look at, let's pull up Starbucks, SBUX. I don't know if we have that trade on or not. We still got a few days for it to leave. Yeah, the stock is just doing nothing, right? And we sold the 85, and I think we bought the 90, something in that range. We got the 20-day. Everything is leaning this direction. Everything, like you got the ducks in the reverse roll. You got the 200. You got this is the 50 and this is the 20. That was a gold death cross is what they would call it. It's a very strong term, but where the 20 crosses over the 50. And things just don't look that great in the underlying, but it is Starbucks that's trading at 34 PE. Yeah, it's not doing well, but it is a great brand and a great name. Thank you, Anthony. Thank you for the comments, but we'll leave that. All right. Let's look at just GLD. I mean, can we go back to the well? I mean, are we getting a little bit too pretentious by going back? I'm trying to find the right word. I didn't want to say cocky, but I think that pretentious is a good word. Just thinking that we could do another trade in gold and be able to, I think we're 3 for 3 on gold on this show. I don't remember on all my other shows, but so we came back down 338, 342 is about the high, but I don't see a lot of activity today. So 338, we're up to this range. We're here. 342 is there. The downside would be, I see all the way these 333. Yeah. What do you guys think? Would we get bearish on this or would we get bullish? If we did a 1 day, let's see if it's even feasible. If we did a 1 day gold trade, do we got any premiums? 62 cents at the money. Yeah, there's not much there. 225, 362. Well, let's see what it costs. See if the momentum at least hangs to the upside. I want to look at it. I'm not going to say that we would do it, but I haven't looked at a 0 DTE gold butterfly. Buy, sell 2, buy 1. Man, that's a real tight spread. 124, and you got $2, and that's 1. No, don't like it. You're not profitable if it goes above 339. Get rid of that idea. If anything, you would just do a standard butterfly and hope it stays within the $2, which is about 1%, right? 3/4 of 1%, 3/4%. That's the trade. If you were going to do a DTE in here, you would just do at the money, and you'd buy, sell 2, and then you'd do a standard butterfly, and you'd buy that one. 110. You'd pay 110 with the potential to make 2. I don't really like it. But that's what you would do. I'd rather do it that way. Potential to make 90 cents. It'd be a 50-50 play. Let's move on. 123. All right. Any other questions? I think we're good. I think we're good on the trade. If you want to look at an SPX trade, I waited too long. It's 11:24. Let's look at the SPX and call it a day, only to show I'm pretty sure it's going to be really expensive. If I look at, like, let's lean, we always say we would lean bullish on the trade, make sure that the SPX is up. 6642, 6642. Okay, this is not right, but that's part of that derived value thing. So 6642 is where we are at. 6642, we would buy, we'll go 342. We wanted, gosh, we're right in the middle of it. So it's not even really a good example. 6. All right, let's sell this one. Let's go. No, let's do this one. Okay, this 10 points. 35, 25. Yep, sell 2. Buy 1. That's not too bad. 380, $4. I mean, when we're doing them, we're getting, I don't know. I guess I was expecting it to be even a little more than that. But at the money, a little bullish, we've been paying about $330 for it. If we pay $410, the most that we can make is 90 cents. We send that to the what if calculator. If the market goes up, the market is at 630, by the way. So that's an at the money butterfly to the upside. 410. So the maximum that we can make, the maximum we could trade for is 5. So you're looking at $1 on the upside if the market continues on up. If it just hangs in this range, our risk comes in down at the 625 strike, about 10 points down on the downside. Once again, you'd get out at about 2 o'clock. 2 o'clock on, you're risking delta and gamma taking over versus theta. Medium. I like the UNH trade better. We're going to make that the paper trade. I'm not going to screen grab this one. All right. Thanks. No other questions? Thanks for all the comments today. I appreciate that inside the chat box. We'll be back on Monday for the next edition of Options Guide TV, 11 a.m. Eastern Time. I want to thank Tradier once again for sponsoring all these great events and all these hubs. Please check out the hub, hub.tradier.com. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.